Charlie Moore, founder of Rocket Lawyer, a corporate governance expert. What is a controlled company?
Right. So, Corey, it's actually, those are exchange rules. So, first, Facebook is an extraordinary company, and a controlled company is for extraordinary companies because it is extraordinary. It means that one shareholder or a company as that one shareholder controls a majority of the voting stock.
Which is the case.
Of the company.
But this isn't set up for big, huge Silicon Valley companies, right? I mean, you've had companies, Microsoft, Oracle, Apple, where you've had founders, shareholders who are significant.
None of which controlled companies.
Right. So, this rule was set up for what?
Right. So it's really about disclosure. So that's what all the securities rules really come down to. Right. Sunshine is the best antiseptic. You've heard it 100 times.
Well, so like compensation committee. Compensation committee has to say, we compare the salary to these 10 other companies or 5 other companies. The salary is higher because this guy did better. Here's 3 ways we evaluate him to be higher. They're saying they shouldn't have to deal with any of that.
Right. Look, after Enron, primarily, we got Sarbanes-Oxley. We got rules. The exchanges put rules in place. What a controlled company doesn't have to do that all the other companies do under NASDAQ and NYSE rules, Corey, is they have to have a majority of their board be independent, meaning not employees of the company. Facebook doesn't have to do that because they're disclosing that they're taking advantage of the controlled company exemption. Mark Zuckerberg's going to control almost 57% of the voting stock. Now, not the economic interest, which is only 28%.
Well, let's back up here. So these are not SEC. I said SEC rules. I'm wrong. I've been wrong before. You're saying they're exchange rules.
These are exchange rules. These are rules of the stock exchanges.
And so, what kinds of companies do you think the exchanges had in mind when they put these rules in place?
Right. Well, the vast majority of publicly traded companies. So once a company...
No, sorry. What, the controlled companies were who? Like manufacturing companies?
See what you mean.
What I mean?
Well, look, maybe companies, a third of the S&P 500. It's not that there's something inherently wrong with a founder-controlled company. I mean, it can be quite a good thing. Founders can typically take more of a longer view, maybe, than investors who are going and looking at every quarter. So to answer your question, when they put the rule in place, they're probably putting the rule in place just for disclosure purposes so that the investor knows that they're investing in an extraordinary company, a company that's not being governed like all the rest.
Let me take you through that just a little bit, because the rules aren't set up, first of all, for when things go well. Rules and contracts are set up for when things go badly. But these rules aren't just, the rules to exempt companies from this aren't just so, hey, so you know they're not, so you can do this. It's for a kind of company where there's less risk, in theory, right? What kinds of companies might have less risk of abuse?
I disagree with you. I disagree with you. I think that, first of all, it's supply and demand. And so one thing you're absolutely right about is that this is about companies that, when they get into trouble, when things are going great, when things are going well for Ford, nobody cared. Ford's one of the 100-year-old business that has weathered many storms, okay? But Ford has always had 40% of its voting stock controlled by the Ford family. They can veto a sale. They've not elected. That's my point exactly. I'm glad you brought it up. Ford has managed to have extraordinary control over their company without making the election that Facebook has. In fact, we went back and studied most of the companies that have gone public in recent history in Silicon Valley. We can't find any. Groupon, Google, LinkedIn, Zynga, all companies that are significantly founder-controlled but have not elected to be a controlled company.
This is worrisome.
Like Facebook has.
I want to completely change gears really quickly, just like 45 seconds left. Broadcom just came out with an SEC filing, late on a Friday, of course, saying, hey, we're being investigated by the SEC over the issue of taking legal, it's a hard issue to explain, but they're essentially putting money aside for legal judgments.
Yeah, I mean, I can give it a try. I've just seen the 8K recently, which is you file an 8K when you have a material event to disclose. So basically they're saying that a former employee, according to Broadcom, the SEC has said they're going to be launching a formal investigation out of the Los Angeles division of the SEC. Broadcom says that they have already investigated this issue of their litigation reserve, which is a reserve, as far as the 8K says, against potential claims around IP. Now, IP claims can be quite significant, but if we only have a few seconds, I would like to remind everybody you're innocent until proven guilty.
The notion might be a cookie jar accounting issue, one that we're going to keep an eye on. Charlie Moore, will have you back to talk more about this stuff because there's a lot to go into here. Charlie Moore of Rocket.